Hello everyone, welcome to the top stocks for this month. 2023 is soon rolling out and here we are to present the top 5 stocks to buy for December of 2022. 2022 has been a time of unrest for the financial sector. The Federal Reserve is currently combating inflation at levels not seen in decades, and most financial analysts say that an economic recession is probable in the near future. Naturally, the market is responding. Year to date, the S&P 500 has fallen by more than 21%, while the Dow Jones Industrial Average and Nasdaq Composite are down more than 60% and 30% respectively. It's difficult to know which stocks to purchase in these uncertain times, but possibilities and opportunities remain. So let's go ahead and look through these few highly recommended stocks. Number 1. ExxonMobil Corporation. First up, we have ExxonMobil Corporation, one of the best stocks to fight against inflation. This corporation operates the biggest gas station network chain in the United States. Exxon becomes a direct benefactor as gas prices climb, raking in ever-increasing revenues and profits. Surely enough, this stock isn't as attractive when gas prices are down, but it's an excellent choice for this December. Exxon is more than simply just a gas station network. Exxon is involved in every stage of the oil manufacturing process, from underground drilling to the refining and selling of petroleum in their gas stations. With petrol prices approaching $4 per gallon, the corporation is generating a significant amount of free cash flow to its balance sheet, especially when compared to pre-pandemic levels. It is also expected that petrol prices will stay within this range as supply chain issues and global turmoil hampers down on the availability of oil to the public. At the same time, XOM stock is more than reasonably priced. The company's PE ratio is far below the S&P 500 PE ratio at only 9.85, while its price-to-share ratio is nearing 1, which signifies a strong likelihood of undervaluation considering Exxon's market dominance. Currently, the stock has risen 38% year-to-date, with its market capitalization at $357 billion and the dividend yield of roughly 4%. Exxon investors are in an excellent position to benefit from consistent growth and dividend yields. Number 2. ASML Holding NV, an excellent investment option for those looking to capitalize on the semiconductor shortage. ASML stock is down by 45% year-to-date with a market capitalization of over $184.28 billion. A massive semiconductor shortage is affecting practically every sector, from vehicles to computers and even healthcare. Global supply chain disruptions as well as sanctions against Chinese chip suppliers have seriously hampered firms such as Nvidia and AMD, who heavily rely on a stable semiconductor supply. ASML Holdings is an equipment manufacturer that specializes in the synthesis of machines that are able to mass-produce semiconductor chips. These devices are extremely expensive. Each machine costs roughly $150 million to purchase, and these margins are likely to rise in the future. Even with these sky-high prices, Biden's newly announced CHIPS Act is likely going to incentivize chip companies to expand their operations. Despite the possibility of a recession, economists predict considerable profit growth for the remainder of 2022 to 2023. The bottom line is straightforward. In a worldwide supply deficit, ASML has a global monopoly on a tool that is required to make a high-demand product. Its instruments are used to make microchips that automakers, medical device manufacturers, and technology corporations can't get enough of. Now, with the stock's recent plummet, the share price is more than within an acceptable range of value. For our third stock, we have Amazon, which is a great option for the risk-averse investor. Amazon's stock price has dropped more than 33% year-to-date and more than 38% within the last year. With a market capitalization of $1.152 trillion, Amazon is stationed in a very cyclical sector but has lost around 1/3 of its value in this year alone. There's little doubt that certain Amazon investors are beyond irritated right now, but this dip is precisely the best time to purchase Amazon for cheap. Amazon is an e-commerce behemoth with a market share of over 45% and with a compounded annual growth rate of over 13%. Amazon also resides in a sector that is set to grow over $1.7 trillion by 2027. In addition, Amazon has a proven capacity to withstand economic downturns. The stock price of the firm did not even quiver in the face of the COVID-19 pandemic, owing to the fact that it gained enormously from stay-at-home orders and physical retail closures. With Amazon's latest addition, Amazon Web Services, the firm has seen some of the highest operating margins throughout its history. AWS offers cloud computing services and has ties to every major company in the world, from Netflix to Verizon. Amazon also boasts an extremely diversified portfolio of services within sectors such as video streaming, music packaging and delivery, as well as a plethora of other sub-services. With their multitude of income streams, Amazon is one of the most resilient companies out there. Despite the recent sell-off, the company has remained a favorite among exchange-traded funds and mutual funds. This is perhaps indicative of the bullish sentiment attached to the company as the economy recovers. This is not the first time the corporation has encountered significant headwinds, though. Although the stock is now trading in a downtrend, it is highly unlikely to hold indefinitely. Overall, Amazon.com will experience some economic instability within the coming months, but this is nothing that the firm hasn't previously demonstrated to be perfectly capable of managing. For specific information and analysis of Amazon stock, check our video over here. Up next, we have Devon Energy Corp, which we deem as an excellent investment option for income investors. Devon Energy is an oil and gas behemoth with a long history of great performance, with the stock currently up more than 50% year to date. DVN currently has a dividend yield of 9%, a market capitalization of $33.9 billion, and is the S&P 500's highest paying dividend stock. DVN is only paying dividends because oil and gas prices are increasing, certain investors may assume. That, however, is not the case. For the last 29 years, the corporation has continuously paid out large dividends to shareholders, even when oil and gas prices were at historically low levels. DVN also boasts a solid balance sheet and a credit rating with over $21 billion worth of accumulated assets, which is a 112% increase since 2021. Now might be the best time to purchase DVN as the economic turmoil heightens. Lastly, we have UGI Corp, a licensed natural gas and propane distributor with a century of experience. It has paid dividends to investors for 138 years and has increased dividend payments for the last 35 years in a row. The stock has currently dropped 16% year to date and has a market capitalization of $8 billion. Since the beginning of the bear market, many investors' attitudes about risk have shifted. If you've grown more risk-averse and are looking for a reliable utility play with high dividend yields to fill a vacuum in your portfolio, UGI is an attractive choice. Even when the dot-com boom bursted in 2001, the Great Recession hit in 2008 and 2009, and the COVID-19 pandemic in 2020, UGI investors still received dividend increases. Sure enough, the stock price has fallen perpetuously in the last year, but its losses are still insignificant when compared to the S&P 500s. Furthermore, the company's growth indicators indicate that the recent headwinds will only be temporary. This year, UGI generated an increase of 34% revenue growth, 90% net income growth, 85% diluted earnings growth, and 42% net profit growth in the most recent quarter. When you buy UGI stock, you are investing in a firm with over a century of experience and loyalty, one that has never missed a dividend payment to investors and has a track record of beating the S&P 500 during the bear markets. UGI is an excellent choice for those who would like to ease up on the risk brought by these turbulent times. Finally, as the market fails, the stocks mentioned above are good investment options. Given the state of the market, all of these recommendations are large cap stocks and pursue a rather conservative investing approach. Not sure whether your investment plans are viable? Check out this video for an in-depth explanation of the key qualities of growth and dividend stocks. Thank you for watching, and please like and subscribe for more investing content.